Just one prediction from Bruce Richards, joining us here, Marathon Asset Management Chairman and CEO. It's great to see you, Bruce, as always. So has your outlook changed around 2024, given the past few weeks?
You know, it has. Given what we see in the economy, given what we see, with growth as well as inflation, it looks like the Fed's going to move a little sooner than what we originally thought. The higher for longer will be really higher real rates for longer, as opposed to higher absolute rates for longer. So the Fed does move, and the economy is a bit more robust than what I think a lot of us expected at this point in time. And so I'd say that the economy is going to slow substantially next year from the current pace that we're at, but going to continue to grow.
No more recession.
Rates will be a bit higher than what the market's currently pricing, but will begin to lower next year. The Fed moved 11 times when they brought rates from 0 to 525 to 550. 11 times, and that was effectively 21 rate moves if you want to count it in 25 base point increments. And so right now, what's priced in the market for next year is 6 lowerings or 150 base points. I think that's a bit too much. I think the Fed will probably move 3 times. So the market has it right that rates will be lower this time next year, but I think they're way ahead of themselves in terms of where it's pricing markets today.
So you think we're due for a little correction here?
Well, what I'd say is this. I'd say 2-year notes have a long way to drop, because if you spot the curve, if you bring Fed funds all the way down to where it eventually settles in, 2.5%, 3%, not at 0, but 2.5%, 3%, that would put Fed funds, right at 2.5 to 3, would put the 2-year note right around 3%, which puts 10-year notes around 4%. So think about how much 2-year notes can fall, but how little 10-year notes can rally from here. Now, the market will rally past what I'm just saying, because markets go way ahead of where fair value is, but at some point it will come back to fair value when this is all said and done. And so very bullish for the markets, obviously, but I think that the markets are a bit overextended here. Yes.
If we do get 3 next year, is it front loaded, or do you think the Fed wants to cut as the election gets closer?
I think they don't want to cut when the election gets closer, but they don't want to delay if they have to delay. And so, look, I think at the end of the day, they're data dependent, and it's all going to be based upon inflation and growth. Inflation is going to come in closer to 2%, because without OER, we're already at close to 2%.
Right.
And you think that eventually comes along?
I think that eventually comes along, and so it'll have to adjust. Yeah.
So what kind of activity do you expect to be unleashed next year as rates stabilize and go down?
It's going to be the year of the refi. If this year was the year of rates and AI, next year will be the year of refi. And, when you think about AI and what it meant for the Magnificent Seven and where the NASDAQ is on the year, up 43% on the year, relative to S&P and a Dow, it's just absolutely stunning. But if you also think about rates, high-yield bond market, leveraged loan, marketplace, private credit, all doing 12% plus this year. It's a stunning year for how well credit has performed relative to risk. And so when I look at next year, I think it's going to be another strong year for credit, but I also think it's going to be another strong year for credit in what's going to be very strong volumes. So the investment bankers haven't had much to do because M&A activity is down 50%, and PE sponsors have put very little money to work. But as rates come down a bit, then it's going to unleash this activity in the M&A sector, as well as among private equity sponsors. It's going to require a lot of financing. So consumers are going to refinance into these lower rates, whether you took out a high auto loan or a higher mortgage rate loan. There's going to be refinancings there. There's a $500 billion wall of commercial real estate that's coming due next year.
They're going to refinance at a higher rate, right?
Well, hotels we're refinancing now at lower rates. Well, higher rates relative to before,
where they were.
But we're refinancing now. We just wrote this week a senior living loan, which we like, and the banks have backed away from making these loans, and so we're stepping up making these loans. So I think there's a lot of commercial real estate, a lot of corporate refinancing, a lot of M&A, and private equity sponsor buyout to happen next year. That's going to be a boon year. And so it's really ironic that we're reading in the papers today about bonuses being down for the investment bankers and it being a really tough year.
Yeah, we're not going to do $3 trillion.
And we feel for them.